Happy Monday, and welcome to another edition of Accessible Alpha's Market Update. This time for the last of Q3 for the week beginning September 30th. Let's jump right in. First things first, as always, as I discuss what's going on in markets and what's going on with different stocks that I may like or not like. All of the information that you hear is for informational and educational purposes only. So certainly not investment advice, and please take this content as such. So last week, I think I said I'm going to try to get this to 15 minutes, and I released a 40-minute episode. So I promise I'm doing all I can this week to actually get this episode to around 15 minutes. There's a lot to talk about. I've tried to trim it down, but if you have any questions, if I'm not elaborating on things enough for you, please leave comments in on the YouTube video, and we can take them from there. So first things first, let's talk about some market news. I'm going to really stick with more economic news and less company news this week. First things first is we got our third revision of the Q2 GDP numbers, and they were really, really strong. So we can take a look at the plot on the right over here, and the numbers were about 3% for Q2, and they were, I forget exactly what they were. I want to say, just looking at the plot, we'll call it between 1 and 2% for Q1. Still really strong. So we've discussed the past bunch of weeks around, yes, when there's a rate cut, you can either, perform a rate cut because the economy is not doing great. Maybe GDP is negative, we're in a recession, right? Typically, if GDP is negative for 2 quarters, that's what we classify a recession. But that's not the case. So we see these rate cuts coming really at a time of, this kind of soft landing to get the economy kind of reinvigorated, to get investment back underway. And that's exactly what we're seeing here. Huge piece of news last week was China, for the first time in a very long time, has pulled the trigger on a bold stimulus package, as The Economist put it last week. This is enormous because in the Chinese economy, obviously a lot of their fiscal policy is run by the state itself. Yes, we have the Federal Reserve here as a central bank, but for example, in China, the central bank actually controls the mortgage rates, for example. So they're doing a lot over there to invigorate their economy. They're aiming for a 5% GDP kind of growth in 2024. Seemingly, this is going to help them get there, but there's a lot going on with Chinese stocks, with stocks that are impacted by this stimulus package. We're going to talk about that in the winners and losers section. But just a couple of funny quotes here. In that same article from The Economist, an American hedge fund basically said, "Buy everything." I don't know if I'd go that far, but it is something to think about in your own trading when a foreign government makes a change in their fiscal policy. How does that impact your industry that you like or that stock that you really like? With obviously we're very integrated with Chinese stocks and the Chinese economy in a bunch of different ways. But when they drop a large stimulus package like they aim to do, and they aim to do very quickly, that can have some pretty either positive effects or potentially negative effects if you're on the wrong side of it. So back to the GDP conversation back in the US. This is from a slide from last week, but really this is a plot from the Edward Jones weekly market wrap. And now that GDP, we've kind of confirmed, so to speak, the third revision of Q2, seeing GDP in the US at around 3%, we can really confirm that we are not in a recession. And when we're not in a recession, we call these insurance cuts, or at least Ed Jones did, which I kind of like that term. But it's the idea of if you make a first interest rate cut, when the economy just needs a bit of trimming, that's a good thing. And we see on average about 30% forward returns 18 months following the first Fed rate cut. So with the GDP numbers coming out, the third revision in Q2 being so positive at 3%, seemingly we're off on a really good foot. Again, more technical analysis kind of has to play in for me personally in the markets before I start buying Nvidia and Apple and Google and all the leaders. That kind of got us where we are in 2024. However, these are all really good signs. So if you have some stocks, some positions, some industries, some trades that you've been kind of waiting on, all of these signs seemingly are indicating that we could see a nice little bull run towards the end of the year. Let's hop over to the indexes. Few things going on, but honestly, kind of a draggy week. Nothing too crazy. We do have to keep in mind that we are at the end of a quarter. We're getting to the end of Q3. Q4 is going to be, starting next week clearly. So basically, what we see is, we've broken above our high, but I think potentially because we're at the end of this quarter, we're probably not going to see a ton of buying activity until the new quarter begins. That's typically what we see in markets. So, we'll see if that happens again, but with the strong economic data that we're seeing, getting above these new highs on the S&P and the Dow, and the Nasdaq's lagging a little bit, but not too badly. It seems like things could be taking off in a really great direction in Q4, but time will tell. We'll pay attention in the first couple weeks of Q4, and hopefully some large investors, get back into the kind of aggressive names, so to speak, like Apple and Google and Meta and companies like that. But we'll have to wait and see. But so far, so good. I talk a lot about patience. I'm a trader that needs some confirmation in the market before I enter positions. I don't think we're there yet, but I can say things are looking pretty good. So I'm excited about where the indices lie. Let's talk about winners and losers. So let me go over here. As I mentioned a little bit earlier, China clearly had this large stimulus package that'll be kind of being enacted over the next month or two. And two of the winners, well, actually all three winners are related to this in some way. So the first I wanted to point out are, Wynn Resorts and Las Vegas Sands. I will say that these are obviously not the best charts in a general sense. So on the top here, we have the daily chart, and the bottom we have the weekly chart. These are typically the time frames that I'm looking at for some of my trades. These are not the best charts, but you can see this very large, spike last week. And the reason being is Wynn and Las Vegas Sands have very large casinos in Macau. And if there's the stimulus package in China, and theoretically that means the Chinese citizens are able to borrow more cheaply. They're able to typically maybe get paid a little bit more at work. They're going to have some more disposable income, and maybe they'll take that disposable income and go to the casinos. At least that's what the market thinks. I mean, these are really, really large spikes. So again, as I mentioned earlier, if you're interested in a stock, it really pays to not only pay attention to the fundamental nature of the stock, but also these other pieces that are exogenous to that stock, like the markets in which they operate. Another company that I wanted to bring up as a winner is Southern Copper Corporation. And we'll discuss this a little bit later, but it's the idea of some stocks, especially energy. We're going to talk about this in the industry rotations, especially energy, but mining companies, for example, are clearly very tied to the commodity prices that they're mining, or that they're refining, or that they're drilling in the sense of oil. So because China announced this stimulus package, and China is one of the largest consumers of metals, then we would anticipate, and we are now seeing, a rise in, for example, copper prices. And if you are, even though you're a United States company and you're a copper miner, then yeah, you're probably going to see a nice spike in your stock price, because theoretically you're going to make a little bit more money, right? Copper prices are going up. That is the market rate at which you can sell the product that you're mining. I would expect the stock to go up. And that's clearly what we're seeing in Southern Copper Corporation. But as you can imagine, there are a bunch of other examples of this as well. So again, point being here is that, we've discussed kind of the foreign policy risk a little bit earlier, but also if you have a stock like, I know a bunch of folks that are into energy stocks, it really pays to pay attention to energy prices, natural gas prices or oil futures, because that technical analysis can really drive what theoretically can happen to the stock price. So just a good example here, clearly in the winners bucket. The losers, I actually just brought the top 3 losers from last week of the universe that I typically look at, and that universe is over 300 million in market cap, traded on either the NYSE or the Nasdaq, the 2 major American exchanges, and I'm looking for, from a technical standpoint, a relative volume greater than 1. That basically means that the volume in any given day is larger than the 10-day simple moving average of volume. So it's about 177 companies that are in that screening list. These are just the top 3. And I just wanted to highlight them for the reason of, for Sweetgreen, for example, they're now kind of held in this consolidation pattern and kind of, they seem like they're capped out around 36 and a half. But, if that's a loser, maybe something to pay attention to. If you're a breakout trader, this could be a great trade. If you kind of want to ignore some of the fundamentals, potentially, and are more focused on the earning potential in the future. So that's a great one. CNX I also wanted to bring up because back to our commodities conversation, CNX is greatly tied to natural gas. Natural gas has really come down in price for quite a while. However, CNX has kind of been rising. So even though the market price for what they're selling on the market seems to be coming down, we do see this kind of progressive chart. And I'm always a bit wary of things like that, right? Like, I want as much momentum behind a price as possible, and good on them, for trimming cost and being able to post pretty strong earnings quarter after quarter. But, for me as a trader, I'm always thinking, well, if what I'm selling out on the market or what this company is selling out on the market is going down in price over time, that may be something to think about. And you'll see they had this big advancement here 2 weeks ago. Last week we saw a bit of a retracement, which is why they're in the losers bucket. But again, I wanted to point it out because this is another company that is really tied to commodity prices. And then the last loser is actually something in my portfolio right now. Is Arista Networks, and the reason why is they have really, really strong fundamentals. That's why I'm holding them. They finally were able to surpass this high here of around, we'll call it 370, 375. Retraced a little bit. Again, not hugely surprising because they were a pretty big winner in 24, so maybe funds are selling that off in Q3 to open up, some room for Q4. But I'm certainly going to hold on to it, and hopefully we can see some breakout here. But yeah, just after they got through their high basically 2 weeks ago. Last week they saw a bit of a retracement, so we'll have to see what happens here. All right, so let's switch over to the industry rotations. On the good side of things, we saw materials really advance. This chart is a 10-minute chart, basically going back to last week. The beginning of last week on Monday. The pink line here, I can make this a little bigger. The pink line here is the S&P 500 just in a general sense. And then the chart that you're seeing is the sector spider. And remember, the sector spider is an ETF comprised of firms specific to a sector. And the idea here is that you can get a really good feel for how different sectors are kind of moving up and down if you like a stock in a particular sector. Clearly, you're going to want to have some momentum behind your stock. So, if its sector is doing really well, that's typically a good sign. If your sector is not doing well, even if your stock is doing well, kind of like we saw with CNX, it may just be something to think about. Some people are more sensitive to that than others. I happen to be pretty sensitive to it. I want to make sure enough kind of momentum is behind what I'm trading as possible. But that's why I look at these different sector spiders. So, as I look at them, the material sector did really well. Again, this shouldn't be surprising because we saw things like copper, iron ore, you're really going through the roof thanks to that stimulus package from China, or at least that announcement. Industrials, I also highlighted, the going back to, and this says, basically Friday morning. Let's see if I can get this a little bit better here. Yeah, maybe something like this. The general S&P was about, 50 bips up, where the industrials were about, 1.2%. But what's also exciting is that, technology finally seems to be outpacing the general market, meaning the market is fueled by, the technology sector, at least in part, which is exciting for, potentially a bull run in Q4. And the same is true with consumer discretionary. When the economy is healthy, folks are going to be buying things, and when folks are kind of spending discretionarily, that's a good thing for most stocks. So we like to see that. The discretionary sector was up about 2% last week relative to, again, the 50 bips of the S&P. What's moving down is I really did want to highlight energy. And the reason why I wanted to highlight this was, again, paying attention to commodities prices can really inform where you are in a stock if your stock is really dependent on those commodity prices. Again, think, we talked about CNX, which is a natural gas company. Think about the Exxon Mobils and whatnot. If you're interested in stocks like that, or you're holding stocks like that, it may pay to pay attention to the trends of the commodity prices. And as we've seen, energy prices have really come down off their 22 highs. Not hugely surprising that folks are rotating out of this, and we're seeing kind of a cut in that. Healthcare continues to lag. I'm inferring that this is really due to the election kind of run-up. We saw in the debate with Trump and Harris, if some policies come to bear, really in both, but specifically in the Harris campaign, we could see a deterioration of earnings in some insurers and companies that are backing Medicare and Medicaid. That's why these prices are theoretically coming down, but I'm sure there's other things playing in as well. And the final is real estate here. This is a bit interesting because I would have thought that if rates are coming down, real estate could theoretically do well. But right now we're still kind of seeing a laggard on that effect, so we'll have to wait and see. But real estate was another one of the sectors that didn't do so well last week. All right. Again, highlight on energy prices here. I just spoke about this, but if we look at crude oil and gasoline, natural gas, heating oil, and again, you can just kind of Google these things and look at futures prices or just general commodities prices, contract prices. The 22 peaks were, for crude oil, for example, were 123 a barrel. The recent price, we're getting down to, and this is as of September 13th, by the way, the recent price is down to about $70 a barrel. You have 44% off its high. The same is true for gas, natural gas, and heating oil. Gasoline at $5 in 22. Now we're down to $3.24. Natural gas, we were at $9.48 at the high. Now we're down to $2.13, almost an 80% reduction in price. So again, when we start to look at CNX, cool. It's great that they're posting great results quarter over quarter, but unfortunately, it doesn't seem like the resiliency is there in the market for what they're actually putting into the market. So I just pay attention to things like that. And then heating oil again at $5.15 and 22, down to $1.67, or almost 70% off its high. So point being, may pay attention to commodity prices if a stock you like or an industry like is really dependent on those commodity prices. So next week, kind of a boring week, to be honest. Not a whole lot happening. Carnival will be announcing earnings on Monday. The reason why I put it in yellow there is that their fundamentals are okay, but it is kind of an interesting chart if you look at the daily chart. Again, I'm always looking at consolidation patterns and are companies beating their highs, especially when the market is also trying to beat their highs. They're kind of in that interim of, almost back at their highs. So we'll see what earnings does for them. On Tuesday, the manufacturing PMI numbers come out. That's actually really interesting because PMI can be a good leading indicator for the economy in general. PMI, if you're not familiar, basically how that works is the folks in the manufacturing industry are polled or are surveyed. And they kind of just, on a few different dimensions like employment or inventories or contract prices or things like that, they're asked just, is business improving, kind of staying the same, or is it not improving? Is it declining? And because of that, the idea is that if you get a PMI reading over 50, that's a good thing. Over 50% is a good thing. It certainly has tracked that way. So it'll be interesting to see, especially with rate cuts and potentially this bull run, that we're seeing. I'm always paying attention to leading indicators, and the PMI result could be a good one. Nike's also going to announce their earnings. I actually put this chart right on the slide. It's that top chart there. We don't have to get into that. I know the numbers are really small. We don't have to worry about that. But the idea is that Nike's not been doing well lately. These are daily charts, not been doing well lately. But now with the new CEO, they're working on a couple of the new initiatives. Obviously, since they've announced earnings, the price has been up almost 20%. So very much still off its highs, and certainly not something that I would get too excited about. But we'll see. I think that this is going to be a really interesting call to see, how Nike is dealing with the situation that they're in now. Such an iconic American brand, and where they're potentially going to go for the future. So on Wednesday, we have RPM that's going to announce, and Levi. RPM actually highlighted, that's the bottom chart there. And the reason why I highlighted it is kind of the opposite story. Again, it's really strong fundamentals, or relatively strong fundamentals. They're not, crazy great, but pretty good. And again, kind of back at their highs. These are the earnings announcements I pay attention to, because this could blow, this could blow this chart wide open, especially if there's a lot of momentum behind that price. Thursday, initial jobless claims come out, and then Friday, non-farm payroll comes out. Again, those are important because when we think about Fed policy in a general sense, the Fed is really has two charters. They're trying to keep inflation to around 2%. Clearly, they're in easing rates, they feel like things are trending in the right direction, and they are. We're about 3% now. But the other charter that they have is to keep unemployment as low as possible. Right now, it's at about 4.2%. But with the non-farm payroll report coming out and initial jobless claims, we'll get a good check on where unemployment is. Finally, Apogee is going to announce their earnings. And again, I put that in green, not because I'm buying it, but because it's a good chart. They're back at highs. They have good fundamentals. And if you're a breakout trader, this could be an interesting play. Again, especially as the economy, really whips into shape. So something new I wanted to talk about this week. I'm going to try to do this every week. I'm going to do like a trading tip of the week. And basically the idea here is risk management. This is something that is so critical if you're a professional trader, and something that I basically never see on the amateur side. Or if I see it, it's not done well or kind of considered nearly enough as it should be. But when we think about risk management, it is absolutely critical to trading always. And doesn't matter what asset class or how you trade or what your strategy is, you have to have a really strong risk management. So what is the general concept? The general concept is you need to know how to get out with small losses on bad trades, and you need to know how to let winners ride. Obviously, there are different trading techniques and styles and kind of what you feel comfortable with, but in a general sense, strong trading comes from getting out when you're wrong, and when you're right, making the most of it. And the idea here is if you do that well, actually, you can win far less than 50% of your trades and still be a profitable trader. Because the idea is if you're wrong, you get out quick. And let's say you're right 1 out of 10 times, which hopefully your win percentage is a little better than that. But let's say you're right 1 out of 10 times, but that one clearly makes up for the losses of the other 9. You're going to be a profitable trader. So this is something that's really critical to trading, and something that I certainly don't see enough on the kind of amateur trading side. And you will see with an enormous amount of rigor and passion on the professional side. So maybe tips to think about here, and these are kind of tried and true tips, but they're good. Tips to think about. Here's 3. Know where you're going to get out before you get in. So when you go to place a trade, let's say you trade Apple, let's say, and it's trading at 200 or something. Know that, hey, if it dips below 190, I'm out. 100%. right? If that dips below 190 for whatever reason, I'm out. And obviously, if Apple takes off, you're going to want to stay in. I'm not going to talk about in this episode about pyramiding, which is basically the idea of when you're right, you kind of add on more. There's a way to do that. I don't want to kind of cloud the waters right here, but the idea is that know where you're going to get out before you get in. Or if we've been talking about breaking out, trades breaking out of consolidation patterns, what a lot of folks will do, professional traders will place a stop right below the consolidation pattern. So as we're kind of zigzagging back and forth in this range, we break out of this range, it could dip back down into the range, but it probably won't break out below that range. But if it does, have a stop there, right? So these are things that can really help. Second is only trade a fixed portion of your available capital. This is probably the one I see most often where, especially with retail traders, they're like, oh, I put 50% of my capital on NVIDIA. Holy moly, if that doesn't go the way it's supposed to, and you lose 50%, just how math works, on the next trade have to make up 100% just to break even. That's not a great situation. So a lot of traders, including myself, every trade that I place, I basically have a limit of how much capital I'm going to put on that trade. Even if I love it, even if I think it's the best trade of all time, I still have a limit of how much I'm going to put on there. And then the third is, and this is so true, at your stop, get out. Always, never, ever deviate from this. So whatever your stop is, if it's below the consolidation pattern, if you just have a 5% loss, whatever it is, if you're at a 5% loss, get out. What a lot of folks will do is the exact opposite of what they should do. If they have a winner, they get kind of excited and they sell it for profit. If they have a loser, they get emotionally attached to the trade and they basically say, well, it'll come back, right? Like I just gotta wait, and if I wait, it'll come back and the market will turn around, and maybe it will, but maybe it won't. If a price is going down, it's probably going down for a reason, so get out. Just try again. Maybe wait a little bit for a better setup, hit a new name, wait a month, like whatever it is, it's about capital preservation when you're wrong. So think about this. There are so many kind of great articles and books and all sorts of stuff out there around this, but this is something that a lot of folks don't do enough. Just a quote from Bruce Kovner from Jack Schwager's Market Wizards. If you haven't read that book, I highly recommend it. It's basically interviews with professional traders. Kind of a long quote, but Bruce Kovner manages hundreds of millions of dollars in the currencies markets. And he was asked, what is something that novice traders don't do well? And his quote was the following, quote, "First, I would say risk management is the most important thing to be well understood. Undertrade, undertrade, undertrade is my second piece of advice. Whatever you think your position size ought to be, cut it at least in half. My experience with novice traders is that they trade 3 to 5 times too big. They're making 5 to 10% risks on trades on a trade that they should be taking 1 to 2% risks. And what he's saying there is 5 to 10% of your overall capital. Especially if you're new to trading, trading can be fun. It's a great intellectual exercise. You should be making 1 to 2% bets. And if you can't, figure out how, right? Go to a broker that has fractional shares. If you're trading futures, trade the micros instead of, the E-mini, for example. There are ways to reduce your position size, and I would completely agree here that anytime I've made a big mistake trading, it's you get too far over your skis. And when you're right, I guess that's great, but if you're wrong, it can really hurt you. So trading tip of the week, something to think about there. Thank you so much for supporting Accessible Alpha. Again, just getting started on this, but so far the reception's been really great. So if you have any comments, please leave them on the YouTube channel and on the video. I'm happy to read them and respond to them. Or if you have any kind of feedback for things you'd like to see, by all means, please leave that as a comment as well. And then on the Apple podcast and on the Spotify podcast, please rate the podcast. That really help. And we do have a Discord. That link is going to be in the description of the video, but Discord is a way where we can chat in real time. You can ask questions. We can communicate throughout the week, especially as these big news events take over. If you have questions about trading or whatever it is, I won't give advice necessarily, but I will certainly maybe offer some experience or some general pieces to look at or books to investigate or folks that I really like in the market. So come visit our Discord. It's a ton of fun, and thank you so much. Hopefully you had a great wrap up to Q3, and here's to a great Q4. I will see you soon. I'll see you next week.